Global metal prices trade firm as the US dollar weakens. Nifty metal gains over 1%, while metal stocks like Tata Steel, JSW Steel, JSPL surge in trade.
ICICI Lombard is under pressure on the back of a weak performance in Q4. The management tells CNBC-TV18 that they're optimistic regarding FY24 and will grow by 100 to 200 basis points higher than industry levels.
Piramal Pharma surges almost 8% after the company gets a US FDA conclusion for their Sellersville manufacturing facility.
Glenmark Pharmaceuticals settles with the plaintiff group on a cholesterol drug, Zetia generic, with a $48 million payout. The stock reacts positively.
Som Distillery is up 5% after its arm begins commercial production of enhanced beer capacity in Karnataka.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, Mangalam, it's a bit of a quiet session today. We're oscillating, between the red and the green. For the time being, we're down close to around 20 points. But as we've been seeing for the last many days, the big story is in the mid-cap index because that continues to hold with gains and outperform the headline index. Good time to get in a quick technical check. Kush Bora joins us to tell us how is he reading the current movement in the markets. Hi, Kush. Good morning. Thanks so much for joining in. What's your view, Kush? We seem to be holding on to that 17,550 on the downside. But on the upside, it seems that the markets are positioning for a bit of a fight at around 17,850 to 17,900. What's your trade on the index?
Hi, Nigel. First off, thank you for having me on the show. You've summarized it quite well and made my job easy. FI is selling results around the corner and muted global results, muted global cues, right? So some of these indicators suggesting that the markets could remain range bound. I would suggest that the bias could be slightly negative and, not by much, only for the coming days, up until the expiry. The reason is very simple. 17,700 and 17,800 call bases are massive. And only now this morning are we seeing some kind of, writing on the 17,600 put. Also, the 200 DMA comes, close to 17,550, 17,600 levels. So the markets may not give it up as easily, but the bias could remain slightly negative on the Nifty. But that said, banking index and, stock specific action are plenty. So I would focus, outside of the indices, or in fact, if I were to focus on the indices, Bank Nifty is the one that I would have on my radar for buy on dips. Any dip close to 41,800, 41,700 zones would be a buying opportunity, for Bank Nifty with targets of 42,800. For the Nifty, as we discussed, 17,500, 17,600 would be the support zones, and 17,800, yes, will likely act as a resistance zone in the near term.
All right, that makes sense on the index. But, it's the individual stocks where the story is largely because, if you look at it right now, a big move underway in a lot of these names, a lot of them from the pharmaceutical pack as well. Sequence Scientific, for instance, up around 7%. We have Shilpa Medicare doing well. And even in the broader markets, something like an Amara Raja battery is up around 4%, TVS Motors up 2%. So individual stocks, no problems there. 1,700 advancing for about 1,000 declining. Do you think it's better to place stocks than the index right now?
Oh, for sure. Because, the divergence between the Nifty and the Bank Nifty cannot last for too long. So if the Nifty remains under pressure, I think the Bank Nifty will also give way or at least not, give a breakout rally. Hence, staying in stocks makes, all the more sense. A couple of stocks on my radar. The first one being Raymond. This stock has been in a very beautiful uptrend for a very long time now. And we've seen follow-through buying also come in. On certain days where the stock is ended in the green, the volume action has also picked up. So I think Raymond should be on, one's radar. 1,500 would be the target. 1,400 would be the stop loss. One more stock from the auto ancillary space, which has been doing very well. In fact, the entire auto ancillary space has been doing well. JBM Auto, we've seen a very clear breakout, and there was a consolidation for 3 or 4 sessions. And yesterday we saw a breakout, and today we're seeing a follow through. So JBM Auto is one other stock that is on my radar. For a fresh entry, 810 is where the target would be. 785 is where the stop loss should be.
All right, Kush. Thank you so much for joining in and giving us your views on individual stocks. With that, we shift focus to our special segment. A few ideas for profit coming in from our colleagues at Money Control Pro. Neha joins in.
Today's stock idea is Star Health and Allied Insurance, which is one of the largest insurance company with a market share of 33% in the retail health segment as of Feb end. Given the retail focus of the business, which contributes more than 90% of the gross written premium, the insurer largely depends on agents as key channel partners. With more than 6 lakh agents, Star Health has the largest agency force only after LIC. The stock performance, however, has been uninspiring ever since the listing of the company, primarily because it suffered huge losses in FY21 and FY22 due to COVID-related claims. However, with the waning of COVID impact, the underwriting performance of the company has significantly improved in the current fiscal. In terms of valuation, the stock is currently trading at around 6 times book value as of December 2022. In terms of valuation, it is trading at a premium valuation as compared to ICICI Lombard General Insurance. However, Star Health's premium valuation is justified given its market-leading position in a structural growth sector, favorable product profile which is retail-oriented, a large distribution network, healthy solvency profile, and improving profitability. Investors, however, should be aware of the risk of proposed composite license which can disrupt the business of Star Health. Nevertheless, the stock offers good risk reward in the medium term, and investors can consider the stock at the current levels.
All right, Neha, thanks a lot for that. Well, the market's still pretty much sluggish, down a paltry 25 points odd. For the time being, we'll slip into a short break. You come back. We continue our focus on markets and stock-specific action. Don't go anywhere.
Welcome back. Let's talk about a couple of stocks now. We have Titan on our radar. Titan's mildly in the green right now, but two positive developments have taken place on the counter. The first one, and this is Kotak understanding from its industry interactions, that the company has gone ahead and reduced the incentives that it goes ahead and pays to franchisee, or commissions that it pays to franchisors from this quarter itself. How much is the reduction? For stores which are owned by the company but operated by franchisors, it's been reduced by 50 to 60 basis points from the 5% that it is currently. And for stores which are owned by the franchisees and also operated by them, the reduction is about 100 basis points. And this, remember, they get around 10 to 11% commission out there anyway. And this happens over the next 2 years. So what is the margin positive impact of that? Well, Kotak believes it could be close to around 50 basis points over the next 2 years. Most of that would be front-ended itself. But importantly, this they don't expect any backlash from franchise owners, and they expect the company to tighten the leash further on overall costs. However, the bigger positive from a stock market standpoint is that CLSA has gone ahead and said that their non-jewelry business will be scaling extremely fast, and in that they are most bullish on eyewear business. Remember, Nigel, a couple of weeks ago when the Lenskart deal happened with ADIA, we had said that people will now start valuing Titan's eyewear business. It could have been anywhere between 8 to 10,000 crores. CLSA has now begun to ascribe value to the eyewear business, and they've ascribed almost 15,000 crores as the valuation of their eye care business, close to $2 billion. And as a result of which, they lifted their target price as well, close to 31.50. Why is it that the stock is not running away right now? Because higher gold prices would keep a bit of a tight leash on demand. So that's something we'll be watching out for.
Okay, all right. Manglam, thanks a lot for making sense on that. Well, ICICI Lombard, that's the one that's getting a bit of a knock post its Q4 numbers. Surbhi is with us to run us through a quick analysis about those numbers. Surbhi.
Thanks so much for that. So ICICI Lombard will be in focus today. That's because the earnings were a mixed bag. The GDPI, which is the gross direct premium income, missed estimates, but the PAT beat estimates, and that was largely due to higher investment income. The GDPI was up 7% on a year-on-year basis. The net earned premium was up 12% on a year-on-year basis. The combined ratio also remained elevated at 104%, which was in line with the estimates. The company continues to guide a combined ratio of 102% by FY25. The claims ratio was also higher than estimates, and that was due to higher claims ratio in the motor third-party portfolio. The management continued to remain cautious in the motor business given the competitive intensity. Now that, combined with the regulatory requirement of bringing down the stake of promoter entity ICICI Bank, continues to be an overhang for the stock. Brokerages also have a cautious view on this. Jefferies has a buy rating, but they've cut their target price to 1560. They say for FY24, you have to watch out for the rise in cost of reinsurance and also how industry adapts to the expense of management rule. They trimmed their estimates by 3 to 5%. They further say that the stake sale and the CEO succession may limit the re-rating of the stock. JP Morgan has a neutral rating, but they've cut their target price to 1160. They say the motor portfolio is likely to remain competitive, and the comprehensive product portfolio, which is P&C, may see lower profitability due to increase in reinsurance rates. They don't have the visibility to price in a beat of the management guidance of 102% of combined ratio by FY25. Additionally, Morgan Stanley has an overweight with a target price of 1400. UBS has a buy rating with a target price of 1445, and Nuvama is the lowest amongst all. It has a hold rating with a target price of 1200.
All right, Surbhi, thanks a lot for that. In fact, we also got in touch with Gopal Balchandran, who's the CFO and Chief Risk Officer at ICICI Lombard. And this is what he said when he spoke about the measures that the company was taking to bring down its combined ratio.
So there are multiple levers that we kind of work with. Clearly, in terms of increase in pricing is one of the levers that we kind of largely look at. For example, on the retail health, this February we have kind of effected a price increase of about 19% on the renewal part of the health segment. So therefore, pricing is definitely one of the levers that we have. We equally look at actively focusing a lot on claim service efficiency, because that typically forms the bulk of the combined ratio breakdown if we were to look at. And third, and more importantly, we will continue to make our investments in various areas of expanded distribution, but early signs of success of those investments translating into incremental revenues is already something that we are seeing. Over the last 15 years, the market has compounded at 15%. And given the opportunity that one is seeing, even in terms of the road forward, particularly when you look at, let's say, FY24 or beyond, we believe the market should continue to grow in the range of 15 to 20%. And from an ICICI Lombard standpoint, we would obviously want to see a similar kind of maybe beating the market by maybe 1 or 2 basis points over the market growth rates from a revenue perspective.
All right, well, JP Morgan, they continue to remain positive on Coal India, which is good news. And remember, they already were positive on it, and they had a target price of close to around 285. They've upped that marginally to around 290 rupees. The key reason is they're looking forward to that FSA price hike coming about. Remember, the company has already gone and revised the wages. So the higher wages will hit the P&L, but they not yet got the positive impact of higher FSA prices. And to give you a number, FSA sales constitute close to around 80-85% of their total sales volume. So that's a very, very positive trigger that we're looking forward to. In the last few years, close to around 5 years, we haven't seen any price increase on the FSA side. That's in January 2018 itself. Now, if they can deliver stable to better than expected earnings, that's what will aid their dividend payouts as well. So the street is waiting by for that, and JP Morgan is viewing that as a positive. They also highlight that FIs, foreign institutions or foreign investors, they've been a little bit cautious because of this ESG. Now it seems they're discounting that. And that's why, in fact, in the last 2 years or so, they've increased their stake by around 130 basis points. So JP Morgan is pointing that out as well. Overall, they're positive on the stock.
All right, Nigel, that's about JP Morgan on Coal India. But, we had a new listing today, which is basically the land assets of BEML. They listed at around 292 rupees a share, clearing the path for a partial divestment of the government's stake in BEML. Vivek joins in to tell us more about this listing and the way forward. Vivek.
Well, absolutely. So, it's been a much awaited trigger as far as BEML is concerned. So first, what's actually happened today, BEML Land Assets Limited, the company that has been listed. What is this company? This company was earlier part of BEML, and this particular company was formed to hold all of the land bank, all of the land assets of BEML. And remember, BEML shareholders received shares in BEML land assets in a 1:1 ratio. And this particular company was demerged from BEML in October 2022. So listing is effective today. The stock listed at 292, but now is at the lower circuit. When you're talking about the valuations itself, the actual value of the land bank that analysts were penciling in yesterday were closer, was quite high, close to 8,400 crore. In fact, some analysts went as far as ascribing a valuation of close to 500 rupees a share. So it's a disappointment in terms of the listing or the price discovery process that has taken place. And after that, the stock has also hit the lower circuit in the session today. But why is this important for BEML? Now, coming to BEML, Now, this particular move clears the path as far as the divestment plans of the government. Government intends to divest almost 26% stake in the company, and this was a key hurdle. Now, what actually happens going forward? Analysts are anticipating the government will start inviting EOIs, and the process for divestment of BML will go forward, which is why both of these companies are in focus in the session today.
Okay, all right. Thanks a lot for that, Vivek, for joining in and giving us that update. Well, let's also listen to Gautam Shah, founder and chief strategist at Goldilocks Premium Research, and get his outlook on the markets along with his top sector bets.
I want to obviously start about pharma because it was a sector which was in a mega bear market for almost 18-20 months. So that index has come up really well, and I see further upside. This finally looks like a turnaround for good. You know, there have been multiple turnarounds which failed in the last 12 months. But this turn, I think, looks very, very good on the charts. And I do believe that the pharma index can give you anywhere between 10 to 15%, even from these levels. And on the downside, I think we are watching this important support of 17,500. So if at any point of time this breaks, I think the bears can be back. We love real estate. I think it's always was our favorite in the last 2 years. It's just that because of the market correction, the index came off. But the big boys actually, stood out. I mean, look at a DLF, look at an Oberoi Realty. Despite the market weakness, they stood out really well, and now it's coming back quite strongly. Most of the mid-cap IT stocks have actually held out. I can give you a lot of names, a Persistent, a Cyient, and whole host of names which have done quite well in the mid-cap IT space. Large-cap IT has been a bit of a problem, but I see it as an opportunity for long-term investors.
All right, so that's the word coming in on the market technicals from Gautam. With that, we'll take a short break, come back, get you more on the markets and individual stocks. Stay tuned.
Welcome back. You're tuned in to Chartbusters. You're on CNBC-TV18. Well, let's get to our special segment, Quarter Se Quarter Tak. Abhishek is here to run us through the expectations coming in from the NBFC sector. Abhishek?
Well, non-banking financial companies, that is NBFCs, are expected to report a strong Q4 FY23 in terms of results, driven largely by higher disbursements and recoveries despite the potential impact of rise in interest costs or interest rates on their net interest margins. So there is a strong underlying consumption demand seen across segments of housing, vehicles and consumer durables, which is likely to support the disbursals trend for NBFCs. Housing finance companies are expected to report growth in the low to high teens with stable net interest margins, and SDFC Limited and Canfin Homes are expected to report good numbers. So commercial vehicle is the other sector which is expected to report strong growth in mid-teens, that is 15% to over 25% due to strong disbursements. Gold financiers over there, you can expect the pickup to sustain in this quarter in terms of quarter-on-quarter growth rate, with Muthoot Finance expected to report positive sequential growth, while Manappuram Finance is likely to report negative growth on a sequential basis. Consumer finance is expected to report better growth given the fact that there is improved macro seen in Q4 with no asset quality woes expected, but there may be some pressure on the net interest margin. So according to key estimates by Antique, SDFC Limited is expected to report net interest income at about 4,929 crore, which is up 5.1% YOY and about 0.3% sequentially, and they are expecting profit of SDFC Limited to be up 1.1% YOY and about 1.4% sequentially. For Bajaj Finance, they are expecting net interest income growth of about 26.9% YOY and 3.5% quarter-on-quarter, while profits of the lender is expected to grow at more than 26% YOY and about 2.6% sequentially. For Cholamandalam, Antique is expecting net interest income growth of about 20% YOY and 1.7% sequentially, while they are expecting the bottom line growth of 0.3% YOY and about 1.1% sequentially. For Muthoot Finance, Antique is expecting net interest income growth of about 10.4% YOY and about 10.6% sequentially, while profit is expected to decline by 0.4% YOY but be up about 6.1% quarter-on-quarter. Back to you.
All right, Abhishek, thanks a lot for that. So those are the previews that one can expect from the NBFCs this time around. Just leaving you with the market just beneath the flat line right now, floating around that, while the mid-cap index continues to outperform. We wrap up on Chartbusters. Stay tuned. Trading Hour comes up next.